Hey everyone, thanks for having me. I'm happy to be joining you all for the North American Bitcoin Conference. My name is Bonello. I'm the Director of Research at Grayscale Investments. Today we're going to talk about valuing digital assets, which is a topic that we get a lot of questions about at Grayscale. I'll start with an introduction, move to valuation taxonomy, and then talk about valuing Bitcoin and Ethereum, and finally the current state of the market. Like I said, my name is Phil Bonello, Director of Research at Grayscale Investments. Grayscale is the largest digital currency asset manager with approximately 25 billion under management, spread across 9 different products. My background is I was head of research at Ikigai Asset Management, which is a long-short multi-strategy crypto hedge fund. Prior to that, I was an analyst at Messari. And so I want to talk about valuation, and I think a good place to start is just this valuation taxonomy. So I think about valuing digital assets in 2 broad categories. The first is productive assets, and the second is non-productive assets. Productive assets simply generate cash flows for the holders of those assets. So 2 common token structures are work tokens, where cash flow is associated with some sort of work, maybe staking or providing security to the network, or governance tokens, where holders of a given token have power to vote over what happens on the network, and they have power to vote on what happens to fees, and so those fees may actually end up accruing to governance holders, and that's why I say that they can be categorized as a productive asset, because cash flow will at some point probably flow to governance tokens. And then on the other side of the fence is non-productive assets, and non-productive assets are a little harder to value. They don't have cash flows. The main example in the digital ecosystem is, of course, Bitcoin. It's a store of value. It doesn't have cash flows. It's like a digital gold. There's also in digital ecosystem, there's digital artwork or non-fungible tokens. Also, in the same way that there's physical artwork and it's tough to value, digital artwork has no cash flows, and it's the value of it is whatever someone's willing to pay. So valuing Bitcoin. We actually wrote a report a few months ago titled Valuing Bitcoin, which this presentation borrows from heavily. So if you're interested, visit the website. You can see more in-depth description of all of these metrics. The easiest way to think about valuing Bitcoin is really from a relative value standpoint. So Bitcoin's at approximately $730 billion market cap, when you can compare that to global gold, which is around $13 trillion, global M1, which is 35 trillion, or M2, which is 95 trillion. And you just start to think, are these appropriately weighted? Bitcoin at under 10% of global gold market cap, to me, seems undervalued. I think that Bitcoin holds a lot of the same characteristics as gold, and I think that's why a lot of us are excited about Bitcoin's potential as an investment. So this is really the most straightforward way to think about valuing Bitcoin, just simple relative value. We can go a little bit further into the weeds, into a little more granular view, and think about the supply of Bitcoin on the Bitcoin blockchain. So what's unique is that we can actually look at the different holding tiers, the age of different Bitcoin on the Bitcoin network. And so you can think of speculators as coins that have moved in the last 90 days, right? They're sloshing around, they're short-term oriented. And then holders as coins that haven't moved in the last 1 to 3 years. So these are more long-term oriented type participants. And generally, from an investment point of view, we want to see a lot of holders and a low amount of speculators. This is kind of counter-cyclical, and when a lot of holders come in to the market, that typically signifies a local top. And in 2017, we certainly see that dynamic going on. But in the last 2 years, we've seen this huge buildup of holders. But in the last 2 months, people have been moving their coins, entities have been moving their coins. And we'll get into, potentially why that is in a second. Bitcoin days destroyed is also a valuable metric from this point of view. Simply, if I receive a Bitcoin, I hold it for 5 days, and then I send that same Bitcoin to an exchange or to another entity, I've just destroyed 5 Bitcoin days. So Bitcoin days destroyed is that aggregate view of all of the ecosystem participants and their holding preferences. So a high amount of Bitcoin days destroyed signifies that a lot of old coins that have been held for a long time, are moving in high volume. And so we see this dynamic really peak around local tops and local bottoms. We can see this kind of trend starting to occur as the top was starting to form in 2017, right around the bottom in the 2018 plunge, I guess. At the top in June and July of 2019. And then again we saw this little spike in March. We're seeing this dynamic play out right now, actually, and I think it's pretty interesting because it seems like there's a big dynamic of kind of Eastern entities are selling to Western entities. We see this in exchange dynamics and when the price of Bitcoin really tends to surge. And what is reassuring, at least from this perspective, is that we know that institutions are actually buying up a lot of this supply. So this very well could be a dynamic of strong hands or selling to even stronger hands, because a lot of these institutions, and we've seen this certainly at Grayscale, have a very long time preference, and that is a positive sign for investors in the Bitcoin market. Whale index is a measure of kind of the rich addresses that hold Bitcoin. So it's addresses with at least 1,000 Bitcoin. And the idea with this metric is we might want to follow the smart money, the entities with a lot of Bitcoin under their control. And so we see in previous bull markets, this metric really starting to increase as we near kind of the inflection point and the markets really start to move. And we've seen that in the last 2 or 3 years. This metric has just constantly been increasing, which I think is a positive sign for continued adoption. And I think we generally want to copy trade the participants who are large entities in the market. Daily active addresses is really important as well, because ultimately Bitcoin is a communication network, right? If there aren't other entities on the network to interact with, then the network isn't all that useful. It's similar to if Facebook only has 2 users, that network is not useful. If Facebook has 1 billion users, then it becomes interesting as you can exchange information with each other. In the case of Bitcoin, we want to exchange value, and it's important that there are other entities to exchange value with. So the daily active addresses has just reached an all-time high. Again, a very positive trend for the Bitcoin network. So as we move on to valuing Ethereum, it's pretty interesting. There are a few different ways that you can think about valuing Ethereum. And we actually have a post that will be coming out pretty shortly that you'll be able to find on our website. So the 3 main ways that I think about it is ETH as money, ETH as a consumable commodity, ETH as a productive commodity. And the reason ETH is seen as money right now is because it's used as collateral throughout the Ethereum ecosystem. So you can think about it in 3 ways. ETH can be thought of as money, ETH can be thought of as a consumable commodity, and ETH can be thought of as a productive commodity. ETH is one of the primary assets used on Ethereum as collateral. So there's a good argument to be made that it should be treated as money. ETH is also certainly used as a commodity on Ethereum as it pays for transaction fees. And then finally, ETH is later on going to become somewhat of a productive commodity when it moves to Ethereum 2.0, because it will both be used as a consumable commodity, but it can also be staked and can earn a dividend or a yield for staking. So when we think about ETH as money, we want to compare it to other monies. So currently its market cap is about 20% that of Bitcoin. It's about 0.5 that of gold. And so, similar to how we did the Bitcoin relative valuation analysis, we might think, okay, Ethereum at 20% of Bitcoin's market capitalization, is that a fair comparison? Is there a 20% chance that ETH becomes a more dominant money than Bitcoin? Is there a 0.5% chance that ETH becomes a more dominant money than gold? So I think this is, again, just a very simple way to think about ETH's value. And then when thinking about ETH as a commodity, we want to think about the transactions that occur on the Ethereum network, because ultimately ETH being viewed as a commodity, it's used to pay for these transaction fees. So when we look at this chart, transaction fees spiked to all-time highs during the summer, and even now as they've come back down to earth, they're still much higher than they were prior to any point in 2020. And this is just it's a very positive trend because as more activity occurs on Ethereum, more transaction fees occur, ETH is demanded more and more as a commodity to pay. It's almost like a gasoline. And we can take this analysis a little further to visualize whether ETH is over or undervalued relative to historical readings. And so this price to sales ratio really shows is Ethereum correctly priced given this high or low amount of fees going on. So currently we have an enormous amount of fees on the Ethereum network, but price really hasn't moved that much. So that's why we look at the price to sales ratio right now, and it's relatively low. And so will this metric actually come in line with what we see as fundamentals? It's unclear, but I think it's a positive thing to note for investors of ETH. And then finally, we can think of ETH as a productive commodity. And what I mean by this is consumers can use the commodity to pay for transactions. They burn ETH in transactions, and they also pay validators a tip if they want to assume a higher place in line when they're making their transactions on Ethereum. So that's the commodity side of things. But then on the productive asset side of things, the validators can actually use that ETH. They can use it as a productive asset. They can stake it. They can earn inflation, and they can earn rewards from consumers. So it can then generate cash flows in sort of a bond or equity type way, and that they bring in a dividend or a yield. So this is something that I don't think exists really out in any other market, in that it has this dual asset structure, and that it can be consumed, but it can also generate cash flows that are associated with the network. So onto the current state of the network. We talked about the churn on Bitcoin right now. It seems like some of the long-term holders are starting to move their coins. But on the other end of that, we know that institutions are really buying a lot of those coins. So that might be offsetting, and more than offsetting, that kind of on-chain movement right now. On the Ethereum side, activity is really surging. Demand for ETH as a commodity will likely follow. ETH 2.0 could be a very positive catalyst in turning Bitcoin into ETH into this productive commodity type asset. And then finally, a lot of the activity that's going on Ethereum is through DeFi, or decentralized finance. So there's massive adoption going on in DeFi, billions of dollars borrowed, lent, exchanged on a daily basis. And a lot of the applications that are built have really thoughtful asset structures and it will serve as a positive feedback loop for a lot of these different coins, and for the market sector in general. So yeah, I think this is a really exciting time for the ecosystem. Here are our disclosures. None of this is investment advice, of course. And if you have any questions, please feel free to reach out. My email is up here, and you can follow us on Twitter. Thank you so much. Have a good one.